Welcome back, traders and investors. Our final guest today, Anne-Marie Baiynd, author and financial analyst here. She's best known for her book, The Trading Course, A Practical Guide to Profiting with Technical Analysis. Anne-Marie, how you doing this morning?
I'm doing quite well. Thanks for having me on.
No, we're glad to have you on again. Well, it's crazy merger Monday here. Some of the deals are new to us, and some of the deals just kind of popped up here. Do you ever try and take a look at the charts and maybe try and identify some unusual trading activity in a stock or options, and then see what happens as far in the merger market, or do you just pretty much stick with the indexes?
My philosophy is try to understand the charts well that you trade. And so that normally for me means that I sit in a basket, and that basket I really learn to look at. I know where the levels are, I know where people get active in. So I don't normally look at the merger space. I see a lot of folks doing that, but for me, since I already have the attention span of a Cocker Spaniel, when I spread myself out that thin, I don't seem to trade as well. So it works for me if I have that small basket that I look at and I go, okay, this one's ready to move in this particular space.
Okay, so do you have like one big basket, or do you like break it up, between, the RUT, the Spider, the Nasdaq? Do you just have one big basket, or do you take, like, let's say, the S&P 500? Do you pick out 10, 12 stocks in there and try and follow there, or do you just merge everything together?
I merge everything together because I am a technical analyst, but I believe that true good analysis has to have some fundamental flavor, right? So I'm always looking for whether something's going to be releasing information, whether information is going to be affecting technical motion, and if something is going to be moving with the trend versus against the trend. I'm going to be looking at that. The most simple thing for me that I've used since the beginning of the first book, the trading book, is that 20 simple moving average. And often during the evenings or on the weekend, I'll set a screen to see how far away it is from the 20, if it's crossing the 20, and then look at all the other things affecting that to see what's going on. Like, well, for instance, Gilead, that's been moving really rapidly. And about 2 weeks ago, I said, you know what? This thing, well, it's about a week ago, I said, this thing feels like it's at the top of a formation. But it continued to run, which brings me to the points that I was tweeting this morning. When you see negative signals sitting in a very positive trending market, it's a very bad idea to step in front of that trade and take it short because momentum is always going to be against you. But it's something like that, I will look at it and say, you know what? I'm going to watch for that chart to lose its 20 simple moving average on, say, a 4-hour or an hourly, and then sort of gauge what it is that it's going for. So I'll run those kinds of screeners against my big basket, and then whatever pops out, I begin to hawk it down. That and the high betas that you look at every single day, because there's always activity there, are pretty much the way that I play my game.
Okay, now with Merck coming over and taking IDIX, and just can't get into all the details of how it's going to affect Gilead as far as the patents and whatnot, but now you have Gilead trading lower, so your premonition about the move was correct. But now you've had a fundamental event that's kind of triggering it. So now, is that enough of, besides the price action? Do you take into account, the catalyst is what Merck's doing with IDIX? Is that something that, well, now here's a big run up. I don't want to go against the market. I don't want to get to the stock. But here's a fundamental catalyst that might move the stock. Does that perhaps get you into the trade?
That is actually a great commentary because it actually moves right in line with the stock. Because, see, this thing was holding the 20 simple moving average for quite a while, and then about the beginning of the day on Friday, it just began to collapse. And so for me, I will look at that 20, the crossover event comes, and I will think to myself, okay, well, the first thing that's going to happen is that value buyers are going to try and step in at that support because they believe the chart is going to move forward. But because it loses the 20, I'm looking for the failed retake of that 20 because I do believe that the chart's been signaling that it's done. So the information that we have coming across, as well as the technical analysis, are both pointing to the same direction. If I can't grab hold of 82.50 today and recover it nicely, I am going to continue to the downside and have that retrace that we've been waiting on for, what seems like a week and a half.
Right.
So the two of them actually are going together very nicely. If they don't go together, I will wait to see how the chart responds to the news and then establish based on the volume or how it's holding that moving average what I should be doing next. I just read a tweet early this morning. Somebody said, nobody uses moving averages anymore. I am thinking that a lot of us do because you can still see the moving average help you through the trade very well, and Gilead is a perfect example of that.
Could you go just explain to us the moving average that you follow and why you chose that time frame?
I am an intraday trader, and so I do take short-term swings, but most of the time I will be trading all day and then into the next day, but rarely do I hold things for weeks at a time. So I found that the hourly chart holds a tremendous amount of predictive power in telling me whether something is in a trend, in the middle of noise, or about to break. And so it's just been spending, tens of thousands of hours looking at all the different time frames. And for the intraday trade, I really enjoy using that 1 hour to prep me for the morning. The 20 simple moving average, I've been using that so long, I don't even know why I started with it. But it's in the, 4 or 5 years ago, I wrote the first book before the second one that you mentioned, and I was using it back then. I like it. It's a little bit more responsive than that 30,
Mm-hmm.
and apparently a lot of people use it because, there's no magic to a moving average. It works because everybody uses it, and it seems to be something that a lot of people move to, and so I just look at it and I say, all right, am I holding the 20? And if I am holding the 20, I'm going to say, am I holding it and the 20 has a flat slope, or is it trending? If it's trending and I'm holding it, I'm going to check some momentum indicators, and if it holds, I'm off to the races in whatever direction that momentum is telling me. So it's really, I try to make things as straightforward for myself because trading was a difficult endeavor for me when I first began. I was very bad. And so I needed something that was pretty straightforward that allowed me to look at things as deeply as I could because I know I needed to look at time frames, and then from there have something that told me in a step-by-step fashion, take a look at this, then take a look at this, then take a look at this, and if all of those jive, then you got yourself a trade.
Yeah, the KISS method. Keep it simple, stupid. We talk about
Yeah.
that a lot.
Yeah.
Also, you said you do. Do you do a lot of your analysis when the markets close, so you're not getting all, influenced by the tick by tick data? It seems to me that you do that, and then you have your game plan set for the next day, and then you execute it and let the chips fall where they may.
And that's exactly right. If you begin to just stare a chart down or you don't do the prep, remember, in order to perform well, we must have a number of sequences in our mind that says, if this happens, then I'm going to do this, and if this happens, I'm going to do that. It's just like when we're playing a sport or engaging in any kind of activity that involves skill. In the front of our minds, we have to have a particular set of strategies. Like, even working with me right here in this, I'm going to say something and you're going to go, okay, well, she's brought that up. I need to go here. And so that logical train of thoughts got to sit in your mind prior to the event beginning. And if it doesn't, you're going to be moving with the sway and you're not going to have any rhythm and flow. And the market is all about rhythm. You've got to have a rhythm that you can trade and understand, or it's all going to look like noise to you.
Okay, just before we let you go, the Big Apple split here, 7-for-1. I'm sure
I
if
know, crazy.
is it. I mean, I'm sure. I mean, I don't know if it's a stock that you trade a lot, but
Every day.
you do. So, what's your
Yeah,
trade
every day.
today? Give us your trade today.
Well, here's the thing. Apple, to me, looks like it's gotten itself a little bit coiled. And so we've got a pre-market high at about 93.67. And so what I look at is a 15-minute high-low.
Okay.
Now, right now, my momentum indicators are sitting a little bit low. And so what I think is going to happen is a bit of choppy price action. You're going to have big wicks, so don't trade breakouts or breakdowns. Wait for them to retest. And when you've got the retest of the level, then you can establish where it's going. It seems to have nice clean support at around 91.60. We anticipate that more people are going to get involved because Apple's finally at a buyable price for folks to keep in their portfolios. And so I think after this little bit of sideways action, we're going to have a pretty good movement. The prior day's high is where value sellers will try to step in, and that's somewhere around 93.10 or something like that.
93.05. 93.05.
Yeah. And so you want to watch that. If you pop out of there, wait for it to come back and retest it before you take the long. If you take the pop out, be prepared for it to stall about 60 cents higher right now because the charts are showing choppy, sideways, and a pullback into the support action. That's what it is that we're seeing right here. I believe that Apple's sitting in a space that's really going to give people a lot of trouble. If they try to trade between 91.70 and 93, they're going to get chopped around. But if they wait for the hold and they wait for the retest and they're patient enough with that, it's going to deliver. That's what we're going to do.
I think that's the best analysis I've ever heard anybody I've ever asked on a pre-market show for Apple. I swear to God.
Thanks.
No, you were, because you. No, I'm telling you, I really respect your opinion because it is, it did hit 91.63 in the pre-market, and there was a double bottom there from Friday and Monday. So I mean, excuse me, from Thursday and Friday. So they didn't give you a shot to buy it there. And, people are going to be licking their chops up at yesterday's high. 92.95 has been the high. 93.05 was the high on Friday. So if it busts through there, you're going to get some breakouts, some short covering, and that might pop it up 50 or 60 cents. And once that stops, it could flop right back to 93. So
That's exactly right. So
right.
we're just going to be patient and wait it out. The best thing a trader can do sometimes is sit on their hands.
Yep, SOH. Well, I'm looking for it to bust through that 190, 180 level because I think the little guy's buying it at the top, and I don't know, longer term, maybe you can buy this thing, lower. But anyways, Anne-Marie,
Yeah.
thanks so much for coming on. Great analysis. Talk about your indicators, and this is a good time. I'm going to have Brianna mark this time. This is a great time to have you on because right in the heat of the action, you had your analysis ready for us, and we'll keep an eye on it. Thanks for coming on.
Thanks very much for having me. I'll see you soon.
Okay. Bye-bye.